Hello, students. Let's talk about inflation. Chapter 24. In your split edition, this might be chapter 11, I believe. This chapter deals with the cost of living, measuring the cost of living, which essentially is talking about calculating inflation rate. Inflation is a closely watched aspect of macroeconomic performance and is a key variable guiding macroeconomic policy. This chapter provides the background for that analysis by showing how economists measure the inflation rate using CPI and how this statistic can be used to compare dollar figures from different times. So let's go. The questions we seek answers to are what is the consumer price index or CPI? How is it calculated? What is it used for? What are the problems with CPI? How serious are they? How does a CPI differ from GDP deflator? How can we use the CPI to compare dollar amount from different years? Why would we want to do this anyway? And how can we correct interest rate for inflation? So, consumer price index, CPI, it measures the overall level of prices, measure of the overall cost of goods and services bought by a typical consumer. A typical consumer in the United States is probably a typical middle class urban dweller. And it's computed and reported every month by the Bureau of Labor Statistics. The process of calculating CPI, you have to go through this process. Number one, fix the basket. What is in the basket that a typical consumer buys? The Bureau of Labor Statistics surveys consumers to determine what is in the typical consumer's shopping basket. Second, find the prices of those items in the basket. So BLS collects data on the prices of all the goods in the basket. Three, compute the basket's cost. Use the prices to compute the total cost in the basket. And four, choose a base year and compute the CPI. And the formula for the CPI is cost of basket of goods and services in the current year divided by the cost of basket in the base year times 100. Sort of what you see here, cost CY means costs in the current year, kind of using a shorthand here, divide by cost of the same basket in the base year, BY for base year, times 100. That will give you the CPI. In long, you read it cost of basket of goods and services in the current year, that is the numerator in this fraction, divided by the cost of basket in the base year, cost of the same basket, and that is what goes in the denominator. In the base year, BY for base year, and you multiply that by 100. Then you use that CPI to compute inflation. And you got a formula for calculating inflation here. It's the percentage change in the CPI from the preceding period. So here, inflation rate is equal to CPI this year minus CPI last year over CPI last year multiplied by 100. Okay. So let's use an example. First, fix the basket. That was number one. Here, the basket is fixed for us. This fellow is in the basket is 4 pizzas and 10 lattes. Number two, find the prices. Go around and find the prices. Here we have found that in 2014, pizza was costing $10, 11 in 2015, 12 in 2016. Latte was costing $2 in 14, $2.50 in 15, and $3 in 16. Number three, calculate the cost. Okay, the market basket in 14 was costing $60, which is 10 times 4 plus 2 times 10. And in 2015, that was $69. And 2016 was a $78. Cost of the basket. Then we compute CPI. What was CPI? Cost of the market basket in the current year divided by cost of the market basket, same market basket in the base year, times 100 is 100. Why? Because here the current year is the same as the base year. We are given that 2014 is the base year. And so 60 divided by 60 times 100 is 100. And by the way, CPI in the base year is always 100. And 2015 cost, in 2015, cost of the basket was 69 divided by 60. 60 is the cost in the base year times 100. CPI was 115. 16, the cost is 78. 78 divided by 60 times 100. CPI is 130. What do we use CPI for? To calculate inflation rate. There we go. And basically, we calculate the percentage change. From 14 to 15, the inflation rate is 115 minus 100 divided by 100. And what do you get? 15%. 115, which is the current CPI, minus 100, which is the previous CPI, divide by 100, and you multiply that by 100, and you get 15%. And what about 15, 16? 2015, 2016, the percentage change is 13%. Here, the current year, 2016, is 130 minus CPI for 2015, 115, and you divide by 115, multiplied by 100, you get 130. Okay. Let's do some active learning. Calculating CPI, we are already given the market basket. Remember, the first thing you do is to fix the basket. Then we are given the price of the stuff in this basket. And here they have even given us the CPI for the base year. The base year is 2014, and the cost is 120. Okay, number A, compute CPI for 2015. What is CPI? Cost in the current year divided by cost in the base year times 100. So here, number A says cost in the current year. What was the current year? 5 times, this is 2015, 5 times 10 plus 5 times 20. That's what you got here. So the cost in the current year is 150. And cost in the base year, we already given as 120. So CPI for 2015 is 150 divided by 120 times 100, which is 125. Number B, okay. Now, what was the CPI inflation rate from 15 to 16? How do you calculate inflation rate? Current CPI minus previous CPI divided by previous CPI times 100. Just find the percentage change. So here, cost of CPI basket in 2016 is calculated. 16 is 9 times 10 plus 6 times 20, and that is where you get 210. So CPI in 2016, therefore, is 210 divided by 120, that is the base year CPI, multiply by 100, which is 175. So what is inflation rate? Inflation rate was current CPI, which is CPI for 2016, minus previous CPI, which we calculated in A, and that was 125. That was CPI for 2015, divided by 125. This slide left out 100. You have to multiply by 100. So you might want to put 100 there, and that is how you get 40%. Okay. What is in the basket? What is it that a typical urban middle class person spend their money on? That's what who we call typical consumer in America. Mostly food and beverages and housing and apparel, transportation, medical care, recreation, education and communications, and other stuff. And as you can see, housing takes a lion's share of a middle class budget in America. Look like 42% of the budget goes to housing, followed by food and beverages and transportation, then the others. Okay, so at least you know what is in the consumer's basket. That is what we are following here. Let us show substitution bias. Okay, this is problems with CPI. CPI is not a panacea. It is good, it measures the cost of living, but it has got problems, and we are going to highlight one of them, which is called substitution bias. Let us take the basket. The basket is still 10 pounds of beef and 20 pounds of chicken. And in 2014-15, household bought CPI basket. In 2016, household bought 5 pounds of beef and 25 pounds of chicken. Now, why would our household want to do that? This is where substitution bias come in. You notice that the price of beef was $4 in 14, $5 in 15, and $9 in 16. Now, consumers, being the smart people that they are, substitute from expensive stuff to more affordable stuff. So you can see that the consumer bought 5 pounds of beef instead of what is in the basket, 10 pounds, and increased the consumption of chicken, which is now relatively less expensive. And consumers do that all the time. That's what we call substitution bias. Now, let's do some calculation to highlight this case here. So, number A, compute the cost of 2016 household basket. The cost is, of course, 2016 is 9 times 5. That is $9 times 5 pounds of beef plus $6 times 25 pounds of chicken. And then number B, compute percentage increase in cost of household baskets over 15-16 compared to inflation rate. Now, let's go to the answer here. 2016, compute the cost in 16, and that is 195. Okay, 9 times 5 plus 6 times 25. That is what a consumer has spent in 2016. Okay, but what was the inflation rate? By the way, the percentage increase. Okay, number B says compute the percentage increase in cost of household basket over 15-16 compared to the CPI inflation rate. The cost of 2016 basket over 14-15 is 195 minus 150 divided by 150. So actual increase in the cost is 30%. But CPI, we calculated earlier on, was 40%. So you can see that CPI really overstates the cost of living. So when they report the consumer price index, you will want to take it with a grain of salt because consumers are smart. Consumers substitute all the time when they go shopping. They find good deals, but CPI assume that that basket is fixed and that when you go shopping, you are going to buy 10 pounds of beef and 20 pounds of chicken, regardless of the price. So that is one of the weaknesses of CPI. Other problems, our substitution bias, what we're talking about. Over time, some prices rise faster than others. Consumers substitute, which is the example we just saw, towards goods that became relatively cheaper, mitigating the effect of price increase. See, price increase from $5 to $9 in that example. So consumers are buying less beef and more chicken. And the CPI misses the substitution because it uses a fixed basket. Thus, the CPI overstates increases in cost of living. Introduction of new goods, that's another problem with CPI. The introduction of new goods increases variety, allows consumers to find products that more closely meet their needs. In effect, dollars become more valuable. The CPI misses this effect because it uses a fixed basket of goods. Thus, the CPI also overstates increases in the cost of living because new products come in the market all the time, but CPI assume that the basket is fixed, at least until the Bureau of Labor Statistics changes or updates the basket. Uh, the other limitation of the problem with CPI is unmeasured quality change. Improvements in the quality of goods in the basket increase the value of each dollar. The BLS tries to account for quality changes, but probably misses some as quality is hard to measure. Thus, the CPI also overstates increases in the cost of living. Each of these problems causes the CPI to overstate cost of living increases. The BLS, or the Bureau of Labor Statistics, has made technical adjustments, but the CPI probably still overstates inflation by about 0.5% per year. This is important because Social Security payments and many contracts have COLAs, or cost of living adjustment, tied to CPI. Okay. Contrasting the CPI and GDP deflator. We calculated GDP deflator back in chapter 10 or chapter 23, which is also a price measure of price changes in the economy. Imported consumer goods included in CPI. A typical consumer uses and purchases goods that are imports. So imported consumer goods affect CPI, but does not affect GDP deflator. GDP deflator only includes goods purchased domestically. Capital goods are excluded from CPI. A typical consumer doesn't purchase capital goods, and so capital goods does not affect CPI, but since it is made domestically, it affects GDP deflator, if it is, of course, produced domestically. The basket, CPI uses fixed basket. Okay. GDP deflator uses basket of currently produced goods and services. GDP deflator uses current production. It is always updated. This matters if different prices are changing by different amounts. So GDP deflator is perhaps more accurate measure of the general price level in the economy. Active learning 3. In each scenario, determine the effects on CPI and the GDP deflator. Number A, Starbucks raises the price of frappuccinos. Number B, Caterpillar raises the price of the industrial tractors it manufactures at its Illinois plant. Number C, Armani raises the price of the Italian jeans it sells in the United States. Number A, Starbucks raises the price of Frappuccino. The CPI and GDP deflator both rise. Starbucks is made in the United States and consumers purchase it, so it affects both GDP deflator and CPI. What about Caterpillar? GDP deflator is affected because Caterpillar is made domestically, but it does not affect CPI because consumers don't purchase Caterpillars. Armani raises the price of the Italian jeans. That will affect CPI because consumers buy Italian-made products. Those are imports, but does not affect GDP deflator because it is not made in a domestic market. Correcting variables for inflation, comparing dollar figures from different times. Inflation makes it harder to compare dollar amounts from different times. For example, minimum wage in 1963 was $1.25 an hour. In 2013, the minimum wage was $7.25 an hour. How do you even compare the two? Did minimum wage have more purchasing power in December 63 or in December 2013? To compare, use CPI to convert 1963 figure into 2013 dollars. And this is the formula, okay? Dollar figures from different times, amount in today's dollar is equal to amount in year T dollars times price level today divided by price level in year T. Price level will be measured in CPI. Okay? So in our example, year T would be 1963. Today would be 2013. Minimum wage in 1963 was $1.25. That was the year T. CPI in year T or in 1963 was 30.9, and CPI in 2013 was 234.6. The minimum wage in 1963 using this formula, that is 125 times 234.6 over 30.9, and that gives you 9.46. So $1.25 in 1963 has the same or had the same purchasing power as $9.49 in 2013. Okay. Comparing dollar figures from different time, researchers, business analysts, and policymakers often use this technique to convert a time series of current dollar nominal figures into constant dollars, or what we call real figures. They can then see how a variable has changed over time after correcting for inflation. For example, minimum wage. Okay. Active learning for tuition fees at United States colleges and universities, comparing tuition fees. In 1990, private non-profit four-year university was charging $9,000. In 2015, it was $32,405. Public four-year was 1,908 in 1990, 9,400 in 2015. So the question is, express the 1990 tuition figures in 2015 dollars. Use the formula we just see on the previous slide, and that was $1. Read this as $1 today. That's $1 with T. $1 today is equal to $1990 times CPI in current CPI, current being 2015. Current CPI was 237.7, and CPI in 1990 was 130.7. So 237.7 divided by 130.7, and you get the answer here. Okay, that is what you will compare to 2015. Okay, if you compare these two numbers, that in 1990 private college was 9,000, and in 2015 private college is 32,000, you will get numbers that are misleading and wrong. You got to calculate this dollar in 2015 dollars, and you do the same for public four-year college, public two-year college, and let's see the next slide. And we have done the calculation using that formula. So in private non-profit four-year colleges, this 9,340 in $2,015 using that formula is this. So this would be the number that you compare with the 2015 cost of a private college. So you find the percentage change, which is 32,405 minus 16,986 divided by 16,986, and thus we find 90%, 90.8% increase. Okay. And for a public four-year college, the increase in tuition is 171. And for a two-year college is 108. So when they say the cost of higher education in the United States has considerably gone higher, this is the evidence right here. Okay. Indexation. A dollar amount is indexed for inflation if it is automatically corrected for inflation by law or in a contract. The increase in CPI automatically determines the COLA in many multi-year labor contracts, COLA being cost of living adjustment. Adjustments in Social Security payments and federal income tax brackets. Nominal versus real, or real versus nominal interest rate. The nominal interest rate is the interest rate not corrected for inflation. It's the rate of growth in dollar value of a deposit or a debt. So the interest rate quoted in the bank is usually nominal interest rate. The real interest rate is the rate that is corrected for inflation. Okay, rate of growth in the purchasing power of the dollar. The formula for converting nominal to real is real interest rate is equal to nominal interest rate minus inflation rate. Okay, so here in this example, if you deposit $1,000 in a bank and leave it for 1 year, and the bank is paying you 9% interest, during that year, inflation rate was 3.5%. Real interest rate is nominal interest rate minus inflation. That 9% was the nominal interest rate. 3.5% is the inflation rate. So the real interest rate was 5.5%. The purchasing power of that $1,000 has increased or grown by 5.5%, not 9%. Okay, so you have to make an adjustment for inflation rate. Summary. The Consumer Price Index is a measure of the cost of living. The CPI tracks the cost of the typical consumer's basket of goods and services. The CPI is used to make cost of living adjustments and to correct economic variables for the effect of inflation. The real interest rate is corrected for inflation and is computed by subtracting the inflation rate from the nominal interest rate. And that would be it.